Hello and welcome to a CMS Forex daily video recap. I'm your fundamental market analyst, Nick Nassad. Today is Monday, July 19, 2010. Let's begin with some Eurozone developments where Moody's Investor Service cut Ireland's credit rating to AA2 from AA1, though it did upgrade to a stable outlook, indicating it is unlikely to consider a further downgrade soon. The agency cited a rising debt burden, the high cost of rebuilding the country's banking system, and sluggish growth as factors in the decision, though the downgrade didn't come as much of a surprise to markets and it was shrugged off. Traders and investors now await the initial results from the bank's stress tests that are due out on Friday. European regulators are examining the strength of 91 banks to determine whether they can survive potential losses on sovereign debt holdings. Banks will need extra capital, but hopefully the capital will be a reasonable amount that the markets can provide. European officials are trying to mitigate fears by saying that the banks will pass ahead of the actual results, but the market is still nervous and that could weigh on the euro throughout the week. There is a bit of a lose-lose situation in the short term, because if any banks fail, the market reaction may be negative, but if no banks fail, the markets will sour because no one will believe the results. However, when the US unveiled their stress tests, it did help to calm overall financial markets, and it began to rally in March of 2009, so European regulators are hoping for a similar result. Taking a look at the euro-dollar pair from a daily time frame, we see that the euro has managed to climb about 9.5% from its 4-year lows in early June compared to where it started the year. Investors are reassessing the assumptions that have driven currency trading since late December, as signs increase that the US economy is softening while concerns over the Eurozone debt problems are easing. Conditions that appeared strong in the US now appear weak, and conditions that appeared weak in the Eurozone, such as debt auctions, now look strong. But the sovereign debt fears are not completely out of the way, so the bank stress tests will go a ways to give more transparency to the Eurozone financial sector. Zooming in on the price action in the 1-hour time frame, we can expect the 1.30 level, which we tested in Friday's trading and came close to testing in today's trading, will act as an important level of resistance, as it is a key psychological level and may cause the recent euro rally to pause in the short term. We did gain about 2.5% just last week. Going back to the daily chart, if we do manage to move above the 1.30 level and the factors that have been helping the euro continue, we could see a test of the 1.34 area, which would be a 50% retracement of the full slide we have seen in this pair since December at around the 1.35 level. Zooming this pair out even further, we can draw another Fibonacci retracement level from the highs we had seen in 2008 down to our low, and we see that that 50%, that 1.34 area is now also a 38.2% retracement. So there's a confluence of Fibonacci levels pointing to the 1.35 as a very good next level on the upside. Now, investors are divided over whether this trend in favor of the euro will last or prove to merely a temporary reprieve for the euro, resulting from covering massive bets against the common currency as a result of the sovereign debt fears. But as is apparent on the chart, there's been a big shift in sentiment between late May and early June, following these 4-year lows set in the pair, as the news from Europe became decidedly less negative and the US news took a clear turn for the worse. Foreign investors, undeterred by the sovereign debt fears, massively bought Eurozone bonds and notes in May. As they had already started in April, a report showed today the euro saw net portfolio inflows of 63.9 billion euros, due largely to inflows of 42.1 billion euros in debt securities. In addition to the bank stress tests, we're also going to have purchasing managers index data out of Germany and the Eurozone, which could provide clues on the health of the broader economy in the EU. Investors will be searching to see whether the German economy is holding better than expected. Taking a look at the dollar-yen pair in a daily time frame, we see that we have moved below the very important 87 level, and we look close to test the 85 level that we had set in last December. If we move below that 85 level, then the dollar-yen pair would have gone to the lowest level it's been since 1995. On Friday, we touched the lowest level we had seen in this pair since December, after disappointing US consumer sentiment data added to the parade of worse than expected economic indicators that have brought the pace of the US recovery into question. Most economists are already starting to revise down their growth expectations for the US, and that has been pressuring the greenback against its major rivals. Taking a look at a long-term view of the US dollar Canadian dollar, we see that we are stuck between a range of the 1.0750 and around the 1.0150 level, though we did move below that and tested parity in late April. Since June, our trading range has been established at the 1.0675 level and 1.0115 acting as our support. The sideway action comes as the greenback has been weak because of its fundamental data, but the Canadian dollar is experiencing some weakness because of the outlook for the global economy. Also, oil prices have been ranging between the 70 and 80 level throughout the last 3 months, which is not giving the Canadian dollar any impetus one way or the other. Tomorrow, the Bank of Canada is expected to raise interest rates to 0.75% from 0.5%, which will be the second increase in the past 2 months. The bank has 4 rate decisions remaining this year, including tomorrow's. Expectations are that the Bank of Canada, following tomorrow's 25 basis point increase, might increase by another 1/4 of a point to get to the 1% range, but at that point, if there's signs of weakness in the US and the Canadian dollar is flirting at par, the Bank of Canada may pause its interest rate hiking campaign for a while. Data today showed that foreign investors bought a record monthly net 23.16 billion Canadian dollars of Canadian securities in May, fueled by the second largest investment in bonds on record. Foreigners acquired 15.22 billion Canadian dollars of Canadian bonds, the largest since an all-time high about a year ago. This trend of an increased demand for Canadian bonds is one that should continue as the Bank of Canada raises interest rates going forward, while the Fed and other advanced economies stay on the sidelines. Those inflows could slow Canada's recovery by boosting the country's dollar and curbing exports, though it should help to keep Canadian bond yields down even as the central bank raises rates, which makes it cheaper for companies to borrow and invest. Still, as we saw in the Bank of Canada's April monetary policy report, it predicted that economic growth will slow to an annualized pace of 3.5% in the third quarter from the 6.1% rate seen between January and March. Also, the upcoming monetary policy report will be due out on Thursdays with updated forecast figures. Turning to the US, builders in the US turned more pessimistic in July, with the NAHB Wells Fargo Confidence Index dropping to 14 in the month of July, the lowest level since April of 2009 from a downwardly revised 16 in June. It's a sign that the expiration of a government tax credit will continue to depress home construction. The report weakened U.S. equities in the morning trading, but in the afternoon, stocks did manage to move back into positive territory, with the major 3 indexes up around 0.6% near closing time. So that does it for today's highlights and fundamentals. Let's take a look at the upcoming fundamental docket. Tonight, Australia releases its RBA meeting minutes, while overnight we get producer price data from Germany and UK data focusing on public sector net borrowing, mortgage approvals, the M4 money supply, as well as the CBI industrial trends orders. It's a very sparse calendar this week for U.S. fundamental news, and the highlight will be Fed Chairman Ben Bernanke's testimony on monetary policy in front of Congress, which is scheduled for Wednesday and Thursday. In tomorrow's session, we do have June housing starts and permits, with the median forecast is that starts will fall 3.2% to an annual rate of 574,000, while building permits will be little changed. Also, as I mentioned, we will have the Bank of Canada interest rate decision, where the forecasts are for a 1/4 point increase. And that will do it for today's broadcast. For more news, videos, and analysis, please visit our site, cmsfx.com. I want to thank you for watching and wish you good trading.